Okay, welcome back to the show this week, ladies and gentlemen. And we're going to kick off right away with talking about how this crisis now, just in the first few months of 2023, is now bigger than the entire crisis on a financial numerical basis than what occurred in 2008. And of course, I'm specifically talking about the banking sector. And I want to go over a few articles with you today about exactly what's happening. So we'll kick off where we left off on Friday, which was actually not even leaving it off on Friday. That was from a month or so before, where I talked about First Republic. It was one of the banks on the list that I said was looking like it may have some trouble. And of course, over the weekend, the bank collapsed and was taken over by the FDIC. Now, there's a lot of things that the media isn't telling you about with this takeover, which is a few of the things that I want to go over today. So where shall we start? I think we'll start with this article here, because it is confirmed now that JP Morgan took over control of First Republic Bank over the weekend. So in what was no doubt a frantic event. In fact, it says here that there was 800 staff that were working through the entire weekend, through the night, to try and get this deal done, which is very interesting because on one hand, we have the Fed, we have the government, we have the FDIC saying that BOA, so your Bank of America, JP Morgan, Morgan Stanley, is saying these banks are just too big. Because what are they now? Well, what have they been for a long time? They've been too big to fail. In fact, we're going to get onto exactly why JP Morgan purchased First Republic very shortly, because it's not what you think. So let's have a look at what happened then. We know, because we talked about it before, that First Republic was about to collapse. It had a 40 billion asset value in terms of its share price at its peak in November 2021. We already know this, we discussed it before. It then lost half of that and went down to 20 billion. But at the time of the sale, so at the time of close on Friday, which was the last banking day for this bank, First Republic was only worth $654 million. That is insane for a bank to be only worth that. That's all it was worth, $654 million, despite the amount of assets. Now, this is where we come on to JP Morgan then. So what is the media not saying? What is the FDIC not saying? What is the government? What is the Fed not saying? What they're not telling you is that JP Morgan, well, there's a couple of things. We'll go through each one separately. JP Morgan took control of First Republic's $92 billion in deposits, but not the company's $100 billion corporate debt or the preferred stock after buying the bank. That is one of the most profitable acquisitions of any bank in modern history, in modern times. And in fact, JP Morgan, it's no surprise to me that they took it on. I thought it would be between 3 or 4 banks, but it's no surprise that they took it on, because this is similar to what they did in 2008. So if you remember Washington Mutual, not a name we hear anymore because it collapsed, that had $430 billion in assets. So this was just one of the 25 US banks that collapsed in what was known as the Great Recession. And JP Morgan also took that on. So they had $430 billion, and then the other 24 combined was $94 billion. This is where it gets a little bit interesting, because now if we let's look at these numbers. So First Republic, $213 billion, the 14th largest bank in the USA. Silicon Valley Bank, $209 billion. We also had another $110 billion. Basically, you've got $532 billion worth of failures right now in 2023 versus $526 billion of failures in 2008. And the year's only just really started. We're only into Q2 of this year. So we've still got a long way to go yet. Now, the FDIC is in a lot of trouble right now, because what are they doing? What did we talk about last week? It was how they are trying to get all of these other banks to pay into the fund. And I said, why would they need to do that when they've got trillions of coverage for the $250,000 insurance limit? That's what an American citizen gets in the bank, FDIC limit. So why are they asking for all of this extra money? Well, it's because these bailouts that they have done, and they are bailouts, has pretty much wiped them out. So now they are pretty desperate and they're trying to get all the other banks to pay in. Not to mention the fact that the First Republic Bank bailout that they've just done has cost the FDIC around $13 billion. And yet JP Morgan has made a huge amount of profit. In fact, this deal will be worth hundreds of billions of dollars to them. I'll explain why in a moment. It's not just what they've taken on now, but it's the future potential of what they have taken on in the investment banking world. Now, let's have a look at a couple of other points I want to talk about here. We went over why First Republic failed in previous videos, but just a very quick summary, it's because they weren't ahead of the times. They had a huge loan book of 30-year fixed rate mortgages that they had loaned out at very low rates. And then of course, they weren't offering savers high enough rates on the deposits. So we had a perfect storm that brewed as the Fed raised these interest rates, and First Republic have got all of these loans as well as all the bonds that they are holding, so treasury notes. This has put them somewhat upside down. And this is why I find it quite amusing that everybody is coming out, even big banks. In fact, Jamie Dimon, CEO of JP Morgan, just came out and said the banking crisis is now over. It died when we took over First Republic this weekend. But let me just say that I don't think that this banking crisis is over. And that's because, yes, they may have bought First Republic and they may have taken over the assets and the loan book and everything else and all of these branches, but they haven't resolved the underlying problem. And that underlying problem is higher interest rates. So all of these banks now, and they just had this big meeting again last week, and they all sort of did these surveys and they were all in agreement the banking crisis is over. In the most part, most of them did, some disagreed. But that's because they think that interest rates are going to be coming down. But here's the question. What if these interest rates don't come down? That is going to cause a huge problem with your bonds, the treasuries, the mortgages, mortgage-backed securities. It is going to cause an enormous issue, especially for these smaller banks. Now, I got some statistics for you, which I thought was quite fascinating. Smaller banks now account for 80% of all commercial real estate lending and 45% of all consumer lending. Now, what did we talk about just a couple of weeks ago? That was the commercial real estate space, predominantly in the USA. What's happening, we correlated that to the work from home trend and how people don't want to come back to the office, or if they do, they're not coming back for 5 days a week. They might come back for 1, 2, or 3 days. So what is now happening is a lot of companies are downsizing their office space. They're doing hot desks, they're doing all sorts of desk sharing and other similar measures. In effect, they don't need as much real estate space now. They don't need as much office space. So commercial real estate, which is where 80% has been lent from these smaller banks, means that we are in big trouble, or these smaller banks are in big trouble. And although I don't want to accelerate the trend of people moving their deposits from the smaller banks to the bigger banks, as hard as it is for me to say, that is where you are safest at the moment, because these big banks are now too big to fail. But it is very sad to see this, because if you look at how hard it is to open a bank now in any country, let alone the USA, it means that you're going to have less competition, meaning you're going to have poorer services for consumers at a time when credit is already getting tighter for consumers. So as these banks continue to grow, and this is very interesting about JP Morgan, you're going to see a lot less competition, meaning that you're going to have to pay more later on. So when you have these big banks now, which are just accumulating all of these smaller banks, and we're going to see more of this as more of these smaller banks crash and collapse, even though that is not popular opinion now. it seems as though even the media, a lot of the other banks, a lot of the economists say that First Republic is the last bank to fail during this crisis. I personally don't think so. Even Zions Bancorp, Bank OZK, a couple of other ones that are being heavily shorted at the moment. Zions was one that I told you about 3 or 4 weeks ago, which is still holding up, but it's looking a little shaky in my opinion. But here's why JP Morgan actually acquired then First Republic. What they got with this deal was all of their bank branches as well. Where are these bank branches located? In very wealthy, affluent areas. The amount of work that goes into actually finding a relevant space that you want to go into and open your business into is very difficult, and it's very competitive. So what they have just done is they've got these bank branches in affluent areas, and they've taken on all of the deposits, and they've taken on the investment banking services. So before this, JP Morgan had 2.59 trillion in terms of investment banking. Morgan Stanley is the big one, 4.56 trillion, and then Bank of America with 3.52 trillion. Now, remember, Bank of America took over Merrill Lynch during the last crisis. Now, the other interesting thing with First Republic is that they didn't voluntarily close down. First Republic Bank, San Francisco, California, was closed today by the California Department of Financial Protection and Innovation, which appointed, okay, so let me add this in. So it was actually the California Department of Financial Protection and Innovation, CDFPI, which closed them down. So they appointed the FDIC as the receiver. So it gets even more interesting. To protect the deposits, the FDIC is entering into a purchase and assumption agreement with JP Morgan Chase Bank, National Association, Columbus, Ohio, to assume all of the deposits and substantially all of the assets of First Republic Bank. Now, the other thing they got with this deal was all of the bank branches, which I just mentioned. So they get 84 offices in 8 states, which will now reopen as JP Morgan Chase Bank. So this isn't the first time we're hearing this, by the way. There's a lot of other banks that are being acquired at the moment. It's just not in the mainstream media. So I've had a lot of emails from many of you, or comments, should I say, below saying that my bank has just been purchased by, and then it could be JP Morgan or Bank of America or whoever else. So there are a lot of acquisitions going on at the moment behind closed doors as well. Now, in terms of the losses then, this was $13 billion in terms of losses that have been absorbed by the FDIC. Now, again, here's my question. If they keep saying that they can cover all of the deposits of all Americans, then why are they getting so panicky over $13 billion? It just doesn't make sense. On top of this, this is where it gets even more crazy. They actually extended JP Morgan with an additional $50 billion credit line. Now, the other bank that you're not hearing about anymore, and check this if you don't believe me, in all the media here, they've stopped talking about Silvergate. I'm not exactly sure why, but they keep saying that only 3 banks have failed this year, so they're not including Silvergate in this anymore. Why is a mystery. But Silvergate, remember, had $175 billion in deposits as well. So that actually takes it well over the figure I just gave you, which was the $532 billion compared to the $526 billion in 2008. So that takes this over $700 billion. So it's actually a lot worse than what they are saying. Now, this isn't new. You think about all these acquisitions. JP Morgan took over Bear Stearns as well. You hear about Bear Stearns that collapsed, but they don't often say who acquired it and who acquired all of those assets. You see, this is big business when these banks step in and they acquire another bank, because they often don't have to, they can put a deal together. So and especially when they're too big to fail, the FDIC, remember, as well as the Fed and other people, these are bureaucrats. They're not entrepreneurs. Their job is simply to alleviate the problem. They are reactive, they are not proactive. So when the problem presents itself, are they being proactive? Okay, how can we? No, they are waiting until it's right up to the line and they can see the bank's going to collapse, and then they step in and in effect put it out to tender, which is what happened. JP Morgan was one of the bidders and got a really sweet deal out of this actually. Now we've got a bit more banking news going on today as well. So Deutsche Bank has just cut 800 jobs, which has taken analysts by surprise because they had such a strong quarter. So it looks like Deutsche Bank is just consolidating further at the moment. Wall Street is cutting more jobs as Morgan Stanley plans 3,000 layoffs. Now, another thing to add to this is that, remember, they axed 1,600 jobs in December as well. So that takes it to 4,600 jobs just in the last 6 months. Goldman Sachs also announced 3,200 job layoffs in January. So we are seeing a lot of layoffs now in banking. And again, quite interesting if you remember what I talked about on Friday, artificial intelligence. There are more articles coming out now saying that companies are laying off a large amount of staff. Another company is just about to lay off 8,000 staff, and they don't intend to bring those jobs back. Their intention is to give those jobs over to artificial intelligence, which is happening at a rapid rate and much faster than even some people thought my forecasts were a bit extreme in terms of the job destruction that I talked about. And yet now we're seeing it at an even more rapid rate. And if you think about the speed that AI is advancing right now, it's not really any surprise at just how quickly all of these jobs are being displaced. Now, last point then, as we wrap up the video, was that not last Friday, but the Friday beforehand, I talked about this new mortgage policy in the USA. And it was quite interesting the amount of people that thought that, I was making up some sort of story, which was amusing. And that was around these new mortgage policies for people that have good credit versus those who don't have good credit. And I said that this was a form of socialism, as it were, coming in, because what was happening was the people who have good credit and have really looked after their credit rating, pay their bills on time and all this sort of stuff are going to be penalized, and they're going to have to pay more to actually prop up those people who have bad credit, or they haven't made their payments, they've got not a good credit rating, etc. And that this money would have to be transferred over to help those people. And again, a lot of people thought that this was just nonsense, but it's now been officially announced. So this policy begins as of today, the 2nd of May, and already it's caused a huge stir throughout the finance community and the mortgage community. Especially, I wanted to bring your attention to one thing that I looked up, which was something that I'm surprised no one's talked about so far, and that was the 2008 default rate. So I wanted to see within these two brackets, and it's not perfectly correlated, but it's close enough, what the default rate was for the people that had been helped onto the housing ladder versus those people who could afford to get onto the housing ladder with good credit. The default rate was 40 to 55% of those people who had bad credit. I didn't even know that myself. I thought it was around 30-35%. No, it was 40 to 55%. But within the good credit range, it was only 4 to 9%. So that is, again, another very worrying indicator that I think we need to pay careful attention to, because that tells us that if we do start to see a severe housing problem emerging and prices are starting to drop, you're going to see a repeat. And again, this is if, but you're going to see a repeat of what happened in 2008. People will just walk away from these homes. They'll give the keys back and they'll walk away if the house ends up massively underwater in terms of what they paid for it and what the mortgage now is. So that is another thing for you to watch out for now as part of this ongoing decline in the US economy. I don't think it's looking positive. I think we are going to go into this, well, we're already in a recession, but we are going to go into an official, because the government says it's now official, recession, which is only going to start a downward spiral with all the things we have talked about previously in the economy. So we'll leave it for today. I think that's enough information for you to ponder upon. Thank you for being a subscriber here. Thank you for taking my finance course, link below in the description, and the private community as well. And I will see you tomorrow. Take care. God bless you and your family. See you soon.